Hey guys, it's Downtown Josh Brown here with Michael Batnick. Another round of What Are Your Thoughts? We're going to talk about all of the biggest topics going on Wall Street this week, in finance, in the economy. Stick around. Let's see what's happening. Okay, Mike, I want to go first, and I want to personally welcome Michael Burry to the Tesla Woodchipper. This is pretty exciting. It's been a while since we've had a new high-profile short seller decide that they want to throw themselves against this brick wall. What are your thoughts?
I mean, good for him for waiting.
He would have
been wrong. If he did it any day before today, he would have been wrong. So I'm sure he had this in his crosshairs for years and months if not years.
Yeah, as I'm sure most fundamental short sellers have. I mean, how could you not all this time? This is a tweet he sent this week. So at Elon Musk, yes, I'm short Tesla, but some free advice for a good guy. Seriously, issue 25 to 50% of your shares at the current ridiculous price. That's not dilution. You'd be cementing permanence and untold optionality. If there are buyers, sell that Tesla souffle.
They did a little bit. Didn't they just do $5 billion?
Yeah, he can sell stock at will. This has been the thing that the shorts have been saying for 10 years, that they're going to run out of money. And every time there's some sort of a deadline, they either do a debt offering or they sell more stock, no problem. And then the stock doesn't go down because of dilution. It goes up because, look, he does walk on water. He can fund this company on an unlimited basis. Now I think he's fine. I don't think he needs to sell 50% of I don't think he has to dilute by 50%. I think he has permanence. There's $22 billion in total short interest. Did you read this headline? Short sellers have lost more than the entire airline industry's shareholders during the pandemic. Tesla short sellers. Can't be true, right?
Yeah, Ken. I heard a few weeks ago on one of Meb's podcasts that mark-to-market losses were $40 billion, and that must be $20 billion ago. That was like 2 months ago.
Okay.
So they're abandoning ship. If you look at the percent of shares outstanding short, it was 25% last month. Now it's down to 5%. It's basically the lowest it's been ever. So they're throwing in the towel.
It's not even voluntary abandoning the ship. It's being pushed off the ship. So the stock's up 700% in the last 12 months. It's very hard to stay short a 700% rally. I don't think anyone really can, unless your short position's tiny. All right, I wonder if there'll be a movie someday where Christian Bale gets asked to play Michael Burry versus, not sure who would play Elon Musk, but maybe that'll be The Big Short too. I guess we'll find out.
I want to talk about Snowflake. So this company's been public for a few weeks.
15 minutes.
And they're already surpassing IBM in market cap, or they're about to when the market opens. They're $110 billion. They're bumping up. Nah, not really. Oracle, I guess, is their main competitor. The founders came from Oracle. Oracle is $180 billion. So right. This company is so far off the charts in terms of valuation, not even close to anything else. I want to give you some numbers. So they reported their first earnings report recently. They did $160 million in revenue, which I think was up. It was up 120% year over year. So, I mean, they're kicking ass. Nobody's doubting that. But just check this out for a sec. So if they grow their revenue at 100% for the next 3 quarters, or at 25% annualized for the next 3 quarters, so they do 100% year over year in 3 quarters, okay, and their valuation stays where it is, right? So assuming massive growth, that will put them at 120 times sales. Now, for context, 120 times sales for context. And by the way, the fact that they're going to grow at triple digits is not a gimme. I mean, maybe they will, but Shopify did 97% year over year revenue growth, for example. Square is growing at 65%.
What's Shopify trading? 40 times sales?
So I'll get to this.
Okay.
All right. So Zoom, which is completely nuts, right? By all accounts, Zoom is 60 times sales.
Yeah.
Trade Desk is 60 times sales. CrowdStrike is 48. Lemonade just IPO'd 45. DocuSign 33. Twilio 28. ServiceNow 25.
Yeah.
At the peak of the .com bubble, or in the late 90s, Amazon reached a peak of 43 times sales. Cisco 38. Qualcomm 30. This thing, again, if it grows revenue triple digits, will be at 120 times sales. What crack are people smoking?
Well, so all of those companies you listed, the current ones, some of them will have justified the multiple on sales that investors are placing on them, and a lot of them won't. And the bet is which ones will, which ones won't. And whenever we paint with a broad brush and we say these are all outrageous, well, yeah, of course they're all outrageous, but which ones will have been justified?
But my point is
years from now?
Snowflake is such an outlier. So what is going on? Is this the Benioff / Buffett premium? Like, why this one?
It has every ingredient. You're right. It has every famous investor. It has all the right backers. It's in the right. It's not just tech, like broadly speaking tech. It's in the exact right place that you want to be in, which is working with data in the cloud, and it has all the right customers. It's the Jesus IPO. Like, this is the one.
So obviously, I don't know anything about the space, but from all accounts, this is like a company that's actually changing the game in terms of putting databases on cloud servers. Like, this is a new field.
Well,
and
it's the accessing. It's not just putting the data. EMC was doing that on magnetic tape 25 years ago. It's the access to the data and the ability to work with the data in the cloud. What draws the attention of a Berkshire Hathaway to something like this, and I'm sure they get pitched every day, and why do they choose this one versus every other tech startup that they could have funded pre-IPO, is that it's got this kind of toll booth keeper sort of thing. They sit right at the most profitable part of basically business in the world. And they basically decide what goes in, what goes out, who has access, who doesn't, and you pay them a lot of money for it, and they're really good at it. And
so as of the end of July, Snowflake, this is from a Fortune article, Snowflake has 56 customers that spent at least $1 million over the preceding 12 months, more than double that number that it had a year earlier. So the company is doing great. But like, people were laughing about this, like literally laughing about this IPO at whatever it was, 30 billion, 70, and then it doubled, 70 billion. Now it's 100. Now it's 110. I mean, this seems really out there.
There's nothing in those in the valuation stats. Like, there's nothing in classical accounting that brings in the value of a network. And this is a classic network effects business. The more people who are on it, the more people who have to be on it. And if you're a company and you want to work with both your data and other people's data, and you're not in this data lake, then you're just out. You're not in the game. So that's the power of these business models. And nothing in classical accounting can capture the potential of these business models to make money in the future. So it's just like, you either qualitatively understand these businesses, or you're just looking at numbers in an 8K or a quarterly filing, and you just have no idea what you're talking about. That's what's going on right now. It doesn't mean it'll last, but that's who's making money right now, are the people betting qualitatively on companies that have these amazing strategic positions in the future.
By the way, not saying this is going to happen, but obviously all those prices house multiples collapsed and then some in the dot-com bubble.
Of course they did. Of course they did. But we've seen companies grow into them since. Yep. So again, most won't. Let's be honest.
Tesla, for example, the mania that is Tesla is 22 times sales.
Okay. I want to ask you about HBO Max. They put out this teaser where they basically showed their entire slate of movies for 2021. They have 17 films that are going to hit the theaters, LOL, but hit the app, HBO Max app, on the same day. And actually, in this video clip, I guess it was on during like all the football games this weekend, they like dropped the music out, and the guy is like, on the same exact day. And if you were like short the movie theater stocks going into that news, you were just like, thank you, finally. Yeah. So I just think like this is so game changing. And if you are between 8 and 12 years old right now, you're going to watch over the next year, you're going to watch Wonder Woman, you're going to watch like all this whole Tom and Jerry, this whole slate of films at your house for the first time. And maybe you'll have a friend over or whatever. But you're not going to have the same attachment to seeing things in the theater on opening weekend that your generation or my generation have. And I don't think you ever go back, do you?
I think they might go back. I don't know that this is permanent. This has been so widely panned by everybody inside the industry and outside that I wouldn't be shocked if they do this in 2021 and the economy reopens, we get past the vaccine, and this was a colossal failure. Economically, it didn't make sense, and they go back to the way it was.
What if I tell
wouldn't be
you?
shocked.
What if I tell you they actually make more money this way?
No,
Would
they
you
don't.
still have that opinion?
They don't.
They do, and you want to know why?
Why?
They don't make the same money in dollars of profit. They make
What are the dollars? Digital dollars?
no stock price dollars. The bigger their streaming businesses are, the bigger their valuation on the stock market is.
AT&T is at a 10-year low. Nobody likes what they're doing.
Well, hold on. Netflix, Disney's at an all-time high with half its business shut down.
What does Netflix have to do with this? With AT&T? With Time Warner?
Because Time Warner's valuation versus Netflix's valuation. I'm telling you about valuation. Some dollars are worth more than others. Some revenue dollars and some earnings dollars are worth more than others. And I'm telling you definitively, streaming revenues are probably worth 5 times what the revenues of box office
that's a good point.
at a theater are.
That's a good point. But I think that they have so royally effed this up. I don't like they have to do a whole rebrand on HBO Max, and I don't know that they're going to get the subscribers. So if they can turn the ship and make it work, then yeah, you'll be right.
Wait, how did they f it up? I think they're killing it.
No, they're not.
We have an exact opposite opinion.
Apparently, HBO Max has 8 million subscribers. Dude, 8 million.
It just
Are you
started.
kidding me? So
just
what?
started.
Disney just started. They've got like 80.
Oh,
Netflix has 150. Nobody even knows that HBO Max is a thing.
If HBO Max
It's a colossal failure.
if they have 20 million subscribers by the end of 21, having released some of the biggest movies of the year, like Matrix 4, would you say it's still a colossal failure, or would you say same day release worked?
No, if it works, it works. I'll change my
All
mind.
right, so let's revisit this next December. Maybe
I don't know
you'll
that
be
20.
right.
I don't know that 20 is a number, but you could be right. You could be right.
Okay, I see it the other way, but I guess that's why there's a market. What do you got?
All right, I want to talk to you about Jason Zweig's article on on Robinhood.
This is my favorite article of the year.
Reading him write his trades and follow along, I was laughing.
Do you have it up in front of you? You have any pull quotes that you liked in particular? First of all, the title. I started trading hot stocks on Robinhood that I couldn't stop, but he did stop, so he could.
This is good. Whenever a stock's price changes, Robinhood updates it not just by showing an uptick in green and a downturn in red, but also by spinning the digits up and down like a slot machine. This flux of direction and color quickly becomes hypnotic. And I could relate. I told you, I moved my Robinhood account off Robinhood into Schwab because I'm checking it like a crackhead, like it's like a dating app.
Yeah. So
And by the way, we were just talking about Snowflake. I bought 4 shares of Snowflake. Literally, I have 4 shares, and I bought it like 3 months ago because I don't know, smart people were buying it, and I wanted to piggyback. Doesn't change the fact that it's got it insane.
you wanted to be in the club.
But I had like no dollars. I have very little money in this thing, and it's all day long. So I don't know how I feel about Robinhood. I think it's complicated. But if your initial experience in the stock market this is a casino, this is a lot of fun.
No, you don't understand. All these pulling of the slot machine handles, it's going to lead to people becoming longer term slot machine players.
Yeah, of course. Yeah, exactly. Well, the good news is all these slot machines, they're all winners. Every poll wins.
Right. So what people don't understand why this article is so funny, Jason basically invented writing about behavioral investing as like a thing. He didn't invent behavioral investing, but like he was talking about Kahneman in 07.
He would say maybe Ben Graham did. Ben Graham did a little bit earlier than he did.
A little bit. But like Jason was writing about the academic papers that make up the knowledge base. So it's so funny that he did this. This is my favorite part. Signing up was fun and easy. 3 mystery cards emblazoned with question marks popped up. I scrubbed to reveal which free stock I had won, like in a scratch-off lottery game. Confetti showered my phone.
And this is why it's complicated, because not everybody who has an account on Robinhood is going to be a junkie. You know what I mean?
Most.
You think so?
Yeah, problem. I was with you. I thought it was a good thing. Now I'm starting to think it's the same people. Like if Robinhood goes down for an hour, what do you think those users do? They go right to fucking DraftKings. They don't say, oh, put the phone down and start reading Benjamin Graham.
Let me read you a lie. The firm says most of its customers use a buy and hold strategy.
Bullshit. Prove it.
Well, it's intraday buy and hold. And that
Yeah.
98% of them aren't day traders.
It's intraday buy and hold.
I mean,
It's short-term buy and hold. I totally understand that. I'm with
right,
you.
right. What do you got?
I got to recover. Did oil bottom? I think it did.
Oil or oil stocks?
Same. I know it's not, but it is. Did oil? All right, let's start with, did the commodity bottom? And then we'll talk about the stocks in a second.
I hope so. I've got like 13 shares of Exxon.
I think it might have. I don't read about OPEC, which is the Fed of oil. By the way, do you think of OPEC that way? OPEC announces production cuts is the same as the Fed announcing interest rate cuts.
Oh,
but
damn,
then,
I have 68 shares of Exxon, not to brag.
So are you retired now?
I'm working on it. I mean, has energy stocks bottomed? I don't know. They look pretty good. They're going up. What else can I say?
Krinsky says they turned the corner. Look, it's really hard.
And they're still such, but Oxy looks amazing, and it's still what is this?
60% or something? 30%?
I mean, these things could double, and I don't think anybody would notice.
An energy breadth surge. Last week, the S&P 1500 energy sector saw 94% of components trade above their 200-day moving average, the highest reading in 10 years. It's a falling 200-day moving average. So
collapsing.
So calm down. But it's interesting.
But how about this? These names that have these epic bounces, it's never easy to hold. These are never easy holds. I mean, there's gonna be false starts where they fall 25% in a week and a half. You know what I mean? It's never like they never go straight back up.
How about there are hundreds of energy stocks? Why? How could there still be 10 years from now if we're all riding around on batteries? How could there be hundreds of energy companies publicly traded? There's just not a chance. So either they go bankrupt or they get bought and there's like a roll up. But it's just the sector, they're calling it energy sector. It's probably 20 companies that matter, right? By market cap.
If that, yeah, that sounds about right. By the way, like in the first half of the year, I mean, when oil went negative, these names were like the oil services names in OIH. So Schlumberger, for example.
I own SLB.
Halliburton.
It's the only stock I've lost money in. It literally got cut in half.
How long? Cut in half. It probably got cut in half 3 times.
From where I bought it. I suck.
All right. I want to talk to you about Goldman Sachs basket of most shorted stocks. Hit an all-time high.
Hit me with them.
Oh, I don't know what they are. I mean, but I just want to talk to. I just want to talk to you about an idea.
Okay, these are the most shorted stocks in the market, and that basket is making a record high. So let's assume they're all electric car companies, or mostly, right? That's probably what's in here.
I'm sure Tesla's in here. Well, not anymore. But anyway, all right. Forget about that. Forget about the underlying holdings. My question to you is this. Do you think that there are strategies, hedge fund managers that are using this as like a metagame to say, I'm just gonna buy what you're short and you're gonna capitulate. You're gonna get margin calls.
You think hedge fund managers are beating up shorts because they know they have to cover? No, because I don't think the shorts are big enough anymore. I just read about this guy, Horseman Capital, who's like a very well-respected short-selling hedge fund manager. He has like $100 million under management. Like, I don't think the shorts are big enough for a $5 billion hedge fund to use them as a way to beat them up for a trade. I think they've shrunken in an 11-year bull market, as you might imagine.
Yeah, I think you might be right.
Chanos gave a really great interview to Bloomberg the other day, and he was talking about like how shorts can be a maximum of 5% of his fund. And he goes along the S&P 500.
Wait, what do you mean shorts? You mean individual positions?
Yeah, like because Jim makes like investment shorts. Like he does a ton of specific research on companies, and he'll use those bets against the S&P 500 to produce alpha from shorting, but not get like washed away by the market. And he's probably the most successful short seller of all time.
Because he had longs.
35 years he's doing this.
Because he had longs to offset them.
Right. That way the market doesn't knock him out of the box. But there's a generation of short sellers that are just like, yeah, I'm net short the market. Really? Are you? Yeah. How's it going? Not well, but I'm smarter than you. Okay. I mean, Are you though? So like
There's a chart. There's a chart floating around. I'm trying to find it of just total shorts in the market, and as you can imagine, they're gone.
Or they're using options and the bets. You know, if you look at Snowflake and it makes you sick, and you just say, "I bet you this thing loses 20% when they report earnings," you're going to use options for that trade. You're not putting that trade, so that's not showing up in common stock.
Yep.
Like in short interest, but
Yep.
that doesn't mean there aren't shorts there. So I do think they're out there. I just don't think there are any that are big enough that they themselves could be a form of alpha for hedge funds on a regular basis.
I think you're probably right.
Okay, I think we have some viewer topics. Let's go to Duncan.
Hey guys. Today, Brandon asks a question about getting exposure to international stocks, Josh. He says, especially Chinese stocks. If you had to choose, would you prefer to invest in individual holdings or an ETF with broad exposure?
Okay, that's a great question. My personal preference would be either an actively managed fund or an ETF with index exposure. But that's just me. I don't think that I have the ability to pick individual China. I mean, I might be able to do it once in a while, but like deciding to do that for the next 20 years of my life, I really have no interest. I don't want to get to know these companies. I don't want to learn the markets over there to the extent that I would have to. So that would be my preference. It doesn't mean there's anything wrong with getting bullish on JD.com or any one of a number of Chinese tech giants or casino companies and doing it yourself. I just personally prefer not to. Mike, did you see the feature in Barron's last weekend where they asked like 12 people, really, really top people, what to do for the next year or what the biggest themes of next year? Half of them were saying diversify into China. Isn't that weird? It would be the opposite of what I would have expected. I do think you want to have Chinese exposure. If you have an international stock portfolio, I really don't think that you can or should avoid it. Just don't think that you know better than the people who are locally on the ground there because they're going to eat your lunch.
A Wall Street reference.
I mean, honestly.
Did you listen to the rewatchables?
On Wall Street? They finally did it?
It was it was Bill Simmons and Koppelman.
Oh, okay.
Recommend.
I'll definitely go listen to that.
What's up, Duncan?
Okay, so for you, Michael, Matt B writes, as a younger investor who maxes out the IRA contribution limit each year, does it make more sense to front load the entire $6,000 contribution every year and put it to work immediately? Or should I be making 12 separate contributions on the first of each month? For someone who also loves data, I was hoping Michael could do some analysis and dive into these two scenarios. So very specific.
Okay, this is an easy one, and I'm going to stand on Nick Majuli's shoulders for this one. The answer is you lump sum. You put it all in the first, as soon as you can, if you can. And so Nick Majuli did some research. He said over a 12-month period, there's an 80% chance of underperformance if you dollar cost average, which makes sense because most of the time the market goes up. So the longer you delay, the more you miss out. And this is not always, this is like, there's a difference between spreadsheet and real life. And in real life, sometimes there's an emotional component where you want a dollar cost average, but that's if you get like an inheritance. You know what I mean? That's if you have a lot of money. If it's $6,000 and it's money that, you're a young person, then there's no emotional attachment to this. So this is the situation where you just listen to the spreadsheet. And so the answer is you lump sum if you can.
I like that answer. I agree.
Thank you.
Hey guys, we love your submitted topics. So here's how you do it. If you want to have your topic brought up during What Are Your Thoughts, you want to go ahead and send an email to askthecompoundshow@gmail.com, and we read all of them and we try to get 2 or 3 into every week, and maybe one day we'll just do a show where we go all viewer topics. We'll see how that goes. But go ahead and send us those emails. Keep them coming. We love it. Subscribe to the channel if you haven't already. Tell some friends about us. We are blowing up. More people should be watching. We love that you guys come every week for the premieres on Tuesdays. We try to get this thing up around 5:36. So make sure that you're here week after week. Join us for the fun. We live comment, and we love mixing it up with you guys. Okay, we will see you next week. Thanks again, and we'll talk to you soon.